The housing market crash is well and truly underway, with homes finally starting to fall at a rapid pace after the crazy real estate bull run that we saw in 2020 and 2021. The data is getting worse by the month, and we're heading towards a potential housing market crisis in 2023. Looking at new data from Redfin's US housing market report, we can see straight away that house prices are continuing to fall, with the median home sale price falling again, now down to $353,000, which is an 11.9% decline from the all-time high that we saw back in June of $401,000. Similarly, the median asking price of newly listed homes has also fallen, now down to $354,000, which is a 15.1% decline from the all-time high that we saw back in May of $418,000. So house prices have now pretty much erased all of the gains experienced in 2022, and we are now approaching prices last seen in late 2021, in what is one of the longest sustained periods of declining home prices we've seen for many years. In addition to prices falling, housing inventory has been rising at a fast rate since spring and is now at $751,000 despite stagnating somewhat in the last couple of months. This is a sharp surge in active listings, more than double the inventory that we saw in the lows back in February of $347,000. Now, according to Redfin, this brings the number of months of inventory to satisfy demand up to 3.7 months, heights that we haven't seen since summer of 2020. Now, we're also seeing homes selling for below the asking price, with the average home selling for 98.3% of the original asking price. So gone are the days where you could put a house up for sale and watch buyers fight with each other to make bids over the asking price. The situation now is that the seller is often needing to accept a lower offer because buyers are not willing to offer the full asking price. So all of this data suggests that there is now an abundance of housing supply on the market that is only growing by the month, making it tough for sellers to achieve a sale that they are happy with. There is far more choice on the market for buyers, and due to the affordability of housing being so low right now, sellers are struggling to sell for a price that they are happy with and are often required to accept a lowball offer from a buyer. Now, back in spring, there was an excess in demand for homes, while at the same time a shortage of supply. However, in recent months the balance has been shifting in the opposite direction and is now likely to continue doing so in the future. Taking a look at the regional data courtesy of Black Knight, which shows which regions of the US are being affected the most by price declines, we can see that there are a few specific areas that are experiencing the worst declines across the country. So California seems to be the state that has been hit the hardest, with both San Francisco and San Jose suffering from a 13.1% decline in median home price from the 2022 peak, which is a long way to fall in less than a year. Now, following those regions is Seattle at minus 11.9%, San Diego at minus 9.5%, and also Phoenix at minus 9.4%. And if you look across the map, you can see that pretty much every area of the US has suffered from a price drop in median home prices to some degree. Now, many of these are only in mid to low single digit declines so far, so there is still plenty of room to fall further for many of these regions if they are to catch up to the likes of San Francisco potentially. There seems to be no stop in the housing market decline right now, and looking where mortgage rates are right now relative to historical rates, there could definitely be more downside in the future. This payment to income ratio chart provided by Black Knight shows just how unaffordable housing has become. It tracks the percentage of median US income needed to make an average monthly mortgage payment on a house. So as this percentage increases, it means that people are spending a higher proportion of their income on home payments, and therefore means that housing is less affordable for the average person. There has been a small pullback this month thanks to a slight drop in the mortgage rate as well as gradually declining house prices. However, the payment to income ratio is still at a historically high level of 37.4%. This means that it still exceeds the highest point observed during the run-up to the global financial crisis, and you'd have to go back to around 1985 to reach a point where the payment to income ratio was this high. The fact that housing is this unaffordable right now suggests that we still have a long way to go to pull back to historically average levels. Now, part of this pullback could come from mortgage rates falling, however it's not likely to happen anytime soon since interest rates are still rising right now, and in fact there was a 50 basis point rate hike last week which will only drive mortgage rates up further. This therefore suggests that for both the payment to income ratio and housing affordability in general to come back down to earth and reach a more normal level relative to historical data, then we are going to need house prices to fall much further to get to this point. On top of this, there are signs that mortgage delinquencies are set to rise sharply in the near future, as a recent Black Knight report finds that 8% of 2022 home buyers that used a mortgage to make the purchase are now underwater on their purchase, also known as being in negative equity. Now, this works out to be 270,000 home buyers approximately who owe more than their house is now worth, On top of that, a further 40% now have less than a 10% equity stake in their home, which means that as the housing market continues to fall, they are in danger of edging into negative equity as well. So the majority of those affected are the ones that have FHA and VA loans, which are government-backed mortgage loans aiming to help the low-income buyers who otherwise might not be able to afford home ownership. Now, they typically only require a small down payment and are open to borrowers with lower credit scores than what is normally required for a mortgage. In fact, more than 25% of all 2022 FHA and VA purchase mortgage holders are now in negative equity. We are looking at a situation where there is a reasonably sized group of homeowners that not only have low income and low credit scores, but are also now in negative equity on their home and are facing rising interest rates and therefore rising mortgage rates if they didn't fix their mortgage on purchase. Not to mention the fact that the economy is heading towards a likely recession in 2023, in which we could well see a surge in unemployment, which will only harm average income even more. Already the data doesn't look good, as early payment defaults, which are loans delinquent within 6 months of origination, are rising amongst FHA borrowers, particularly over the past year, and are now above pre-pandemic levels. In a recent Fortune magazine interview with Andy Florent, the CEO of CoStar, which is considered to be a global leader in real estate and analytics, he and his team were quite bearish on where the housing market is heading, and he did state that people who think a 10% drop will happen in home prices are dreaming, a 20% dip is more comfortable, insinuating that the housing market definitely has further to fall, in his opinion. Now, he's not the only prominent CEO to pass bearish comment on the housing market recently, as RH CEO Gary Friedman also recently said, "One thing I'm certain of is the fact that the housing market is collapsing at a level that I haven't seen since 2008. I haven't seen this kind of drop since 2008. And RH is a high-end home furnishing retailer that has a market cap of over $1 billion, so Gary clearly has a keen eye on what is going on in the housing market. So hearing statements like this from someone like him is definitely concerning to hear. We also had some bearish housing market predictions for 2023 come out from Redfin analysts recently, in which it is expected that the trend of declining house prices will continue. To summarise, some of the key predictions for 2023 are as follows. Number 1 is that home sales will fall to their lowest level since 2011, with 16% fewer home sales taking place next year compared to 2022. Now, this is mainly attributed to affordability challenges from high mortgage rates, house prices that are still largely elevated, and a potential recession that could impact unemployment. Now, number 2 is mortgage rates will stay elevated all year, ending the year slightly below 6%, which is still extremely high by recent historical standards. You'd have to go back to the peak of the global financial crisis to find a period of time where mortgage rates were this high, which does not bode well for the future housing market outlook. Number 3 is that home prices will post their first year-over-year decline for a decade, with the expected median US home sale price to fall by roughly 4%. But it is also worth noting that in Redfin's bear case outlook, it does predict that house prices could fall as much as 15% by Q3 of 2023, which would be quite a steep drop. And then number 4 and number 5 is that rents will fall, and with that we will see investor activity fall by 25% and bottom out in the spring before rebounding. Now, the amount of iBuyers in the market has fallen sharply in the last 6 months or so, including the likes of Zillow and even Redfin themselves shutting down or vastly scaling back their operations. Now, these iBuyers were great for sellers because they offered cash up front for payments on houses, providing a lot of liquidity for the market. However, these iBuying operations were quite poorly run and in many cases were hemorrhaging money for the business. So we know that the housing market is not looking too great heading into 2023, but the same can be said about the whole economy in general. There is some economic data that is looking very scary, and big names in the investing world like Jamie Dimon, CEO of JP Morgan, and also Michael Burry have been quite vocal about how bearish they are on the US economy next year. If you want to check out a full video that I made on this topic, then click on the screen right now. But aside from that, leave a like if you enjoyed the video, subscribe if you want to see more videos similar to this in the future, and thanks a lot for watching.